What if you could retire early without waiting for a miracle or a lottery win? The answer isn't flashy. It's steady, boring, and incredibly doable if you let index funds do the heavy lifting. This is episode 175 in a simple money series, and today we're breaking down a clear, actionable plan to retire early using index funds. No trade hacks, no hype, just a plan you can actually follow. First, you need a real target. Start with your expected yearly spending in retirement. Write down housing, food, transportation, healthcare, and a little cushion for surprises. Then multiply that number by 25. That's a rough nest egg to aim for if you want to follow a traditional 4% rule. It's not perfect, but it's a useful starting point. If you want $40,000 a year, think about a $1 million target. If you want $60,000, aim around $1.5 million. If you want $80,000, target about $2 million. Remember, this is a starting place, not a gospel. Now, the core plan. Build your portfolio with broad index funds. The simplest, most durable approach is a three-fund strategy. One fund for the U.S. stock market, one for international stocks, and one for bonds. If you prefer a single allocation option, a total world or all-market fund can work too. The key is low fees, broad diversification, and staying away from tricks you don't need. How to set the mix depends on your age and your appetite for risk. Early on, you can tolerate more stock. A rough rule you'll hear is to shift toward more bonds as you get closer to your goal. But you don't have to chase perfect timing. A practical guideline. Start around 60-40 or 70-30 stocks to bonds in your 30s or 40s, then gradually tilt toward more bonds as you approach early retirement. The point is to keep growth in the mix while protecting yourself from big crashes eating into the plan. Cutting costs is not glamorous, but it matters more here than in most other places in life. Pick funds with the lowest possible expense ratios. A few tenths of a percent saved each year compounds into real money over decades. Avoid brokers that push backloaded funds or complicated products you don't need. The simpler your portfolio, the more likely you'll stick with it through the inevitable market bumps. Automation is the silent driver of success. Set up automatic contributions from your paycheck into your investment accounts. If your employer offers a 401k with matching, contribute at least enough to grab the match. Max out any tax-advantaged accounts you have, like IRAs or equivalents if you can. The less you have to think about it, the more likely you are to stay on track. Debt plays a big role too. If you carry high-interest debt, deal with it before you invest heavily. Low-interest debt is a different story, but the general rule is, invest for the long term, and don't drown your plan in interest payments. A clean slate now means more money compounding later. One thing that trips people up early is the withdrawal plan. A traditional 4% rule is a decent starting point, but early retirees face a longer horizon and more volatility. Start with something close to 3.5% to 4% of your starting portfolio per year, and adjust for inflation. If the market is rough in year one, don't panic and don't overspend. If the market is strong, you can be a touch more aggressive. The main idea is to keep the annual withdrawal in line with the portfolio's performance, not your optimism. Here's a practical twist for early retirees. Use a bucket approach. Keep a safety bucket with enough cash to cover 2 to 3 years of spending. This protects you from having to sell equities in a down market to pay living costs. Then have a growth bucket with your index funds designed to fund the longer term. A small portion can be set aside for flexible spending in a long stretch of good markets, while the rest stays invested for the future. This sounds simple, but it reduces the stress of market swings and keeps you from jumping in and out of investments. Targeting a lifestyle that doesn't require a big emergency fund isn't realistic for most people. So, keep an emergency reserve separate from your investment plan, in a high-yield savings account or a short-term, safe place. The point is not to treat your investments like a savings account, but to avoid forced selling during market downturns. Your future self will thank you for the extra stability. Tax efficiency matters, especially if you're contributing a lot. Use tax-advantaged accounts whenever you can. In many places, you can stack accounts and investments to minimize taxes over time. Keep turnover low, avoid frequent trading, and stay away from funds that generate a lot of taxable gains in a given year. With index funds, you can keep the tax hit lower than with many active strategies, but you still should plan for it. Avoid trying to outsmart the market. Index funds are designed to capture the broad market's long-run growth, not to beat every rally. The temptation to chase last quarter's winner or to time the market is real, but it's expensive and exhausting. If you stay patient and stick to your plan, you'll likely come out ahead over decades. Your spending matters as much as your investing. If you want to retire early, you'll probably need to rethink some habits. Simple changes add up. Cook more at home, buy fewer new things, and consider whether you truly need a car, a big vacation, or a premium gym membership. Small daily decisions compound into big numbers over years. The point isn't moralizing, it's practicality. The goal is to free up more money for investments without feeling deprived. Think long-term, but plan for real life. You might face major life events, a health issue, a child's education, or a market crash. A flexible plan helps you stay calm when the noise picks up. If you set up automatic contributions, diversify your funds, and keep a safety bucket, you'll be prepared to weather the storms with less fear. A common question is whether you need fancy strategies to retire early. You don't. The framework is simple. Save a meaningful portion of your income, invest in broad index funds, keep costs low, and stay patient. The seasoning here is time. The more time you give your money to compound, the smaller your daily effort needs to be to reach a big target. If you want concrete numbers to anchor your plan, start with a basic example. Suppose you want to spend about $40,000 a year in retirement and you want that to come from your investments. A rough target is a $1 million nest egg. If you pursue a 60-40 stock-to-bond mix, you could aim for a plan that grows steadily enough and doesn't expose you to huge drawdowns in the early years. If you want $60,000 a year, aim for around $1.5 million. If you want more, you'll need a larger nest egg or a longer time horizon. Now, how do you get there without drama? Keep saving at least a part of your income every month. If your salary is high and your expenses modest, shoot for 40% or more. If your situation is tighter, you may target 20 to 30% and still progress by earning more or decreasing big expenses. The exact number isn't magic. Consistency is. The important thing is to keep the plan visible and automatic. A practical timeline can help you stay on track. Start with the basics. Identify your target, set up automatic investments, choose a simple mix of index funds, and establish your emergency bucket. Every 6 to 12 months, revisit your numbers, not your emotions. If your spending changes, adjust your plan. If your income rises, consider increasing contributions. Here's a quick skim of potential mistakes to avoid. Don't assume you'll beat markets by trading more. Don't neglect taxes. A careless move here will bite you later. Don't overcomplicate your portfolio with fancy funds or frequent shifts. Don't kid yourself about how long money will last in retirement. You need a buffer for the low years and the high years alike. And don't wait for a perfect moment to start. Start now with whatever you have and improve as you go. If you're listening and thinking this is too slow, remember what you're building is a durable engine. Index funds provide the engine, and your discipline provides the work ethic. You don't need to be the loudest investor in the room. You need to be the most consistent. The compounding effect over time is the real magic here. Let me give you a simple, repeatable plan to try this year. Step 1, pick 2 or 3 index funds that fit a 3-fund approach. Step 2, set up automatic contributions to max out whatever tax-advantaged accounts you have. Step 3, create a 2 to 3 year cash bucket to handle non-investment needs. Step 4, decide on a withdrawal rule that makes you comfortable and keep it flexible. Step 5, review once a year, adjust for life changes, and stay the course. If you start today, you'll be surprised by how small changes show up later. Every dollar saved is a dollar that compounds. Every year you stay invested rather than selling in a down market is a year your plan earns more resilience. If this approach resonates, you can tailor it to your life. You can aim to retire earlier by saving more, reducing expenses, and allowing your investments to do the heavy lifting. You can also choose to pursue a semi-retirement or part-time work that keeps the plan alive without turning life into a constant hustle. The exact path isn't a single story. It's your story, adapted to your goals and your life. Before we wrap, a quick reminder. This plan is a framework, not a guarantee. Markets move, inflation changes, and your life changes too. Stay flexible, stay curious, and stay disciplined about saving and investing. If you found this helpful, take a moment to like it. If you want more practical, down-to-earth money talks, hit subscribe so you don't miss the next one. And I'd love to hear your plan. Drop a comment with your target retirement age, your annual spend goal, or the first change you'll make this week to move toward early retirement with index funds. See you in the next video.